Hey everyone, welcome back to another video. And in this video, we'll be talking about the mean reversion strategy. So basically, mean reversion strategy is a classical trading concept which is on the idea that a stock price will tend to revert back to its original or the mean average over the period of time. So if I give you one example, like in this picture only, try to assume that this blue line is $100,000 and the green line above is $150. So over in this period, we'll sell this stock. We won't buy it, or we'll go long on it. We won't short this. We can short, we can long, but right now we'll do the most basic one, which is buy and selling. So in this, we'll sell the stock since it has reached its maximum height. This is what I'm trying to tell you. And it goes back to its original, or it goes back to its average mean, which is here, and it's the vice versa. For example, if the stock is, for example, the blue line is $100, and let us assume that this green line is $50, so it is like 50 mark below its blue line. So in this case, the price would tend to move up and go back to its original form, and this is what we are trying to tell you here. So is this strategy works in the real time? Yes, of course, it works, and it is being used in the finance, in the stock market field for decades now. It was firstly used by the legendary quant trader Jim Simons, and he was the first person who, indicated or made AI or technology into the finance world. So he had a lot of name in the quant trading and in finance. So during this time, if I tell you about Jim Simons more, by using this strategy, he was able to outperform the market and research and get a annual return or a CAGR of about 25%. So yes, this strategy actually works. So we gonna implement this strategy in Python. We'll develop a framework and we'll backtest this strategy as well on two ways. One is the simple mean strategy, and one is the more advanced, or which I call as the multiple mean reversion strategy. So in the simple one, which you see on the screen, we'll be using only one stock price on one asset price, which is the S&P 500, and we'll try to capitalize on the deviations, the historical price, the annual return, the max drawdown that the stock price had. And this would compute both the short term and the long term averages to identify the current prices, which is above or below its recent trends. Now if we go, so we'll also be using the advanced strategy. Just bear with the name, and this was invented by me. So in the advanced strategy, we'll be using some US tickers like the Apple, Microsoft, Nvidia for better understanding of the market and how this strategy can be used in the real life by people like us. So for this strategy, we'll also be calculating the deviations, ensuring the signals and comparable across stocks with different price ranges and volatility. And we'll also calculate the volatility range change and what's the risk or the leverage associated with this. So before, let me go to the code. And when I go to the code, first thing is we import the required libraries like NumPy, Pandas, SYS. This is a really important library that we will use in this strategy. And if we go down, we'll be adding more indicators like the max drawdown, the win rate, the total trades, annual return, and the total return. It's a big difference between total and annual return because sometimes people get confused. So total return is the return you are getting. For example, this you invested your money for 5 years. So in the 5 years, after 5 years, you came to know that your portfolio grew by, for example, 50%. So that is your total return. The annual return could be, 10% per year. It's your annual return. This is very important to know minute details. It really makes a difference while you're presenting. In the Sharpe ratio, the max drawdown, and etc. We'll be going in depth into these indicators as well. So for the simple strategy, the initial capital is about $100,000 with leverage about 1.0, and the short and long of 20 and 5 respectively and all that. And we're gonna backtest this strategy as well and try to prove whether we are getting a good return like the Jim Simons. So when I run, we'll get a graph as well as a info over here. We can see in the terminal here, but we'll first focus on the graph that we got. So we started from $100 back in 2018 and it's been 2025. So we could say we invested our money for about 7 years, let's say that. And during this 7 years, we were able to reach about, 100 and more than like $110,000. Let's say this. So, while seeing this graph, you see there are a lot of ups and downs. This is how the market moves. This is the volatility. Yet we are in the equity market and it's more volatile than the other markets like the gold and the bonds or the debentures. So of course, high risk comes with high reward. So over here, you could see a lot of ups and downs. That back in, in 2000, in the mid or in the late 2014 or 2014, we even got a portfolio return more than like $130. But over here, right now, we are at $110,000 or more than that. I'll say $110,000 for my betterment because I am an Indian, so my calculation goes with the Indian system. So the total return we got is about 15% in those 7 years, which is about we say about 20% per year we are getting an annual return. And the volatility rate is 18%, the Sharpe ratio is 0.2, and the total trades we took in is about 1500, or to be precise, is 1470. We got the win rate of only 50%. So by seeing this strategy, we can say that of course we got a good return. Of course, stock value grew over the time, but this strategy, by using this simple strategy, we weren't able to get a good annual return. And plus, there are some complications since the max drawdown is a lot. What is a max drawdown? Let's try to understand this thing as well. So if I give you one example, I want that if you have calculator, you can use that. So for example, you have a portfolio, let's say, and it is, for example, it rose up to $120, this much. Okay. And let's say after 5 months, that stock, your portfolio went to $100,000. So your portfolio from $120,000 went to $100,000. So you got a price or a media. So you got a 20,000. You went 20,000 below your, you know, the expected one which you previously had. So and when you divide this by $120,000, which was your base price, this was the actual price you had first, and then it marked down. So it went to be about 0.166, and you just multiply it by 100, you get 16.67% as your mark drawdown value. So what is drawdown? So basically, drawdown is the maximum negative or the maximum reduction happened in your portfolio or in your stock price is known as max drawdown. And the win rate is not also good. It's only 50%. So if I'm buying a stock, there's 50-50 chance of it going low and going high. So in general, this is good, but it didn't just meet the expectations which we had. So that's why now we'll be making one more strategy, which is the advanced one. In this advanced one, we'll be using eight ticker symbols, which is Apple, Microsoft, Nvidia, Tesla, and Amazon, Microsoft, Nvidia, Meta, JP Morgan, and Google. And we'll try to now, from this strategy, we'll make sure that it's more complicated, but from this advanced strategy, we'll try to compare that whether this strategy is working or not. And for this, we'll be using the same, the inverse, the annual return, and all that. And we'll try to compare it and try to get a comparison between a simple strategy matrix and the advanced one. And for this, we'll be doing some synthetic test, and we'll also backtest this strategy, and we'll try to, conclude whether this strategy works or not. For this, if we go to the advanced Simon strategy, it's like for each asset, it computes rolling Z scores to standardize price deviation. Now, what is Z score? It's like the way you are giving scorecard of to each assets, telling about its different price ranges, volatilities, etc. And we try in this strategy, of course, we are in the equities, but we try our best to just lower down the volatility rate more, and there's a more leverage that we get. If you remember in the visual code, the simple strategy one, over here, our leverage is about 1.0, which is which this is what we have done. And our advanced one, it's about 1.8. So why it is 1.8? What's the reason? Because the advanced one, the leverage gives you an edge, an advantage than your competitors. So, for example, if I say, uh, you're betting on the horse racing, and you know that number two will win, and the number one will come second or third. So in that case, you have an edge because you know what will be the future ahead. So you have an edge. Now you could, invest like hundreds of millions of dollars on, you can bet hundreds of million on dollars on that horse, and that would win, and it will give you a lot of money. And this is the case in the stock trading as well, on the quant trading. You need to find an edge over your competitors. And when I just cross this, and boom, we got a graph over here as well. So of course, the over here we could see that the prices is same, but the thing is that our daily return has increased. Our drawdown has also been reduced, which tells us that this strategy, the advanced one, is working perfectly. And in general, the this mean reversion strategy is something that we could actually use in our daily life as well. So over here we could see that the total return is about 25%, and the annual return has increased to about 33%. 15% is the annual volatility. Of course, if we see the previous one, it's about 18%, and over here it is 15%. You may think, why it's so low? It's 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 only 18 to 15, but remember, even you're in the market, even 1% or 0.1% can make a lot of difference. So over here as well, a volatility rate of 18% can give you a higher risk than 15%. And of course, 15% is not that low risk. We can also achieve a lower risk, about less than 10% would be, the best we could achieve. But if we compare this, we can conclude that 18% is giving us a more riskiness, a more exposure to, bankrupt or, a negative portfolio. And over here, the max drawdown is also low by, I think, yeah, point that 3% only. And the win rate is about 46%. Now that's very confusing, but the thing is, we have taken a lot of trades, And that's why our win rate is not that much, but we are getting a high return, and this includes that we in general are getting a higher annual return than anything else. Over here as well, the leverage is about 1.8, which gives us a better statement or a better position than our competitors. And this is what mean reversion is. So it is a strategy which aims to exploit the temporary price deviation from the historical average. The Python code provides a clear framework to test both simple and multi-assets, incorporating key quantitative techniques like the set scores and the inverse volatility weighting. So this generates matrix and graphs, allow traders to understand returns, risk, and effectiveness of their trades, making this as a practical tool for exploring the statistical trading methods inspired by the pioneers like Jim Simon. So this was for this video. Thank you for watching. I see you in the next video. Bye bye.